Alright, what's going on YouTube? Welcome to my channel. So today I just want to do a quick little talk about monetary policy, specifically the Fed's response to this whole COVID crisis. If you can even call it that, because in terms of financial markets strictly, you can hardly look back at this crisis given the growth we've seen across most asset classes. And lately, I've seen a lot of people getting worried about inflation and making memes online about how the Fed has been printing money like crazy through quantitative easing, and even some people coming up with conspiracy theories about how the Fed is basically in the pockets of the elites, or there's some deep state that exists with the goal of trying to prop up asset prices because majority of financial assets are owned by the wealthy and all that type of stuff. So I just want to make a quick video out there for those who are either worried about what's going on and just kind of explain it as simply as I can. So to explain it, I'm going to give you a little quick history lesson and go back to the Great Depression. So the Great Depression, as I'm sure a lot of you are aware of, started in the late 1920s and carried on over into the 1930s and is arguably the worst economic downturn the world has ever gone through, certainly since the industrialized era, and it can be evidenced really by how much GDP dropped in those years. Now let me explain the exact definitions of a recession versus a depression because they do mean different things. So all a recession is just a drop in GDP for two consecutive quarters. So it doesn't even need to span a full year. It's just two consecutive quarters where GDP does not grow. But a depression is much more severe, and you're typically talking about GDP drop that continues on for several years rather than just two quarters. Now, I'm not going to go too in depth on what happened in the Great Depression. If you really want to know the full story of the history and what happened and what caused it, you can just go research it on your own. But I do want to talk about the economic explanations for why it was as bad as it was, because it really shaped kind of what the Fed and the U.S. government has been doing today with in response to COVID and in the response to previous financial crises. So one explanation for it is referred to as the Monetarist View, and this was made by Milton Friedman, among other people, and he basically argued that the Federal Reserve didn't inject liquidity into the banking system and didn't bother lowering interest rates. They basically allowed it to fail because all these bank runs were occurring during the Great Depression where people got scared and went to withdraw their money, and the bank didn't have enough reserves on hand to satisfy all these withdrawal requests. So the money dried up and basically people lost their savings. And in fact, years later, Ben Bernanke, who's the former chair of the Fed from 2006 to 2014, he even admitted wrongdoing, saying the Fed should have taken action and they essentially let what would have been a normal recession become the Great Depression. And the other view is the Keynesian view, which says that to help an economy get out of a recession, governments should do things like decrease taxes, increase government spending to help stimulate the economy, so more of a fiscal policy approach. But as you can see, both views point out the fact that when a recession is here, the government and the Federal Reserve have a role to play to help the economy avoid a depression like it saw in the 1930s. So let's just look at what the Fed has done at a high level, and it mainly involves QE, or quantitative easing. And the way you should think of quantitative easing is essentially the digital way of printing money. It's when the Fed goes into the open market and just buys up securities, which is typically stuff like treasury bonds, mortgage-backed securities, corporate bonds, and even corporate stocks in some cases. And what this does is it increases credit, it boosts overall investment, and it increases the money supply because they're essentially creating new money by doing this. Now, why is this important? It's all designed to help weather the storm. Whether central banks buy mortgage-backed securities or they're increasing access to credit, because what private firms tend to do during these times, such as banks, is hoard their cash because in a crisis, lending it out becomes a lot more risky and they're more likely to take a wait and see approach. And this is bad because it can sort of decrease overall economic activity because you need lending. So back in March of 2020, when we saw the COVID fears really at an all-time high and the financial markets began to fall, and then there were worries about some impending recession, action had to be taken. The Federal Reserve couldn't just sit back and do nothing, otherwise there could have been a disaster like what we saw with the Great Depression. So the US government and the Fed now knew that they had to do things such as increase the money supply and keep interest rates low because the economy can go back to normal once the pandemic officially subsides, because they learned from the past that doing these types of things during recessions does tend to work. So that's a really simple explanation of what's going on. Now, Lastly, to address all these fears people are having over inflation and how it can lead to equities losing value, this is something I talked about in one of my previous videos. Well, it's a general economic rule that when money supply increases at a rate faster than the actual growth of that GDP in the economy, you will get inflation because there's essentially more money available to purchase less goods and services, which will naturally cause the price of those goods and services to increase, which is what inflation is. However, this general rule is not always true, and there's several arguments that can be made against this. And if we look at what inflation was like during the 2008 financial crisis, when we really saw no major uptick in inflation, despite the Fed doing something similar in response to that crisis as they're doing now through things like quantitative easing and lowering interest rates. So, really, what you should take away from this is that nothing is for sure, and only time will tell what will really happen. The best thing you can do is just kind of take note of the risks, understand them, and just ignore all that noise and all the fear and just stick to a plan. Because the media and the public in general tends to turn what would normally be just normal news into fear-inducing opinions, and this whole online clickbait culture can get very dangerous when it comes to people's finances because it could make you think irrationally. So education is the way you can protect yourself. Take the time to do it because it's worth it in the long run. And on that note, that's all from me. Please subscribe if you like this content, and until next time.